I would love to tell you, hey, we strategically looked at all our options and we picked the IPO and that's what we wanted to do and we did it. Now, I think it was scattershot, as I touched on. We were looking for funding. We were looking at any source of funding that was palatable. And we weren't successful, or we turned down, I would say, unpalatable options until we got the IPO done across the goal line. In hindsight, as I mentioned, I think I would have probably, if I'd been in complete control, stayed private a little bit longer, matured the technology, and then had a bigger, higher valuation IPO. But that's not what happened. We were literally trying to stay alive. So it's not, I would say, as smart per se, as someone who kind of really focuses on that as the goal. In terms of how we picked a banker, one, as I said, there's a mixed bag in any industry. You're going to have good people, not so good people, and then there's fit with your profile of the company. And we dealt with some, on paper, very qualified bankers who just were not a good fit. And I wasn't strict enough about that, not from negligence, but because I didn't really know any better. And these people have reputation. They have a well-known shingle. They're multi-billion-dollar under assets, under management. So, they've got all the trappings of someone who's done this. And yet, when you look at it, they may not have done a deal of your kind, your size, because a $10 million deal for us is roughly the same amount of work for a banker as a $100 million deal. And some of the people who want to do the $100 million deal don't want to do a $10 million deal. It's not enough for them. So for us, at the end of the day, I think, doing your diligence, asking for references, but, kind of figuring out from their portfolio who they've helped that look a lot like you. And then there's a certain amount of, hiring intuition about, is this person selling you realistically? Are they telling you they can raise any amount of money? I think that's a bad sign. Are they telling you, I think we can realistically raise this, and I think it's going to be with this type of investor? In our case, largely retail investors, very few institutional investors. That adds a lot of volatility, but in our case, thankfully, our banker was able to get it into the hands of high quality retail investors who were well managed by their brokers, and therefore were not in this for a 3% profit in 6 weeks selling your stock after the IPO. So, all of those lessons learned. I don't know if there's a perfect framework for screening these people, but that was my experience, and I'd love to hear Steve's perspective on that.
Well, thanks, Francois. It's an interesting, I think you covered it well. I think it's an interesting exercise. It really does is a cause for some introspection about what your goals are. If you're looking to raise a lot of capital and you're heavy on the institutional side, and you're not going to have a lot of follow-on immediate need for follow-on capital, having a heavier presence of institutional investors is probably preferable to minimize some of that potential volatility. The other end of the spectrum, can be, no liquidity at all. In our first year, I think we traded by appointment, and the stock suffered for it. So I think, if I would go back and look at those questions again, I would try to make sure we paid more attention to the mix between retail and institutional to try to strike an adequate balance. That has ways of sort of evening itself out as you expand your coverage with analysts and expand other funds that are accessible to you once you get some traction. But in the early days, it's a challenge.
Mm-hmm.
And Steve, if I might, Scott, just piggyback on that. I think the liquidity and trading of your currency as a public company is essential. You could end up as a public company with thinly traded stock, and you're essentially a private investment for every future investor. You want to have a certain amount of liquidity so that someone can look at you and say, I like them, I want to invest in them, but I also want to be able to get my money out if I change my mind or there's a better opportunity. And if you're trading 10,000 shares a day, you're essentially a private company with all the burden of a public company. So that's to be avoided. And I think Steve spoke to, you want to have a good bank with a research analyst, hopefully in your field, and a commitment to, issue research as a covered client after the IPO. You want a good investor relations firm to maintain awareness in the market for you, because you need that trading. And for us, it's been very helpful to be well traded, because then you have a currency that you can go to other investors and say, hey, here's our business, and we're liquid.
Mm-hmm. Fantastic. So I think it's quite fascinating that your two backgrounds, so Francois, you're almost exclusively corporate, which I think of as being very sophisticated stakeholder relationship manager kind of skill. That's kind of what you learn, and one of the many things you learn in corporate. And Steve you're in larger startup kind of environments, but mostly kind of entrepreneurial kind of environment. And I'm curious what both of you think, maybe starting with Francois, about now that you're public, how does your background affect how you approach that?
Yeah, I think I started my presentation with, I think the corporate grooming and experience at good companies for a growing and developing manager, as I was in my 20s and 30s and 40s, was perfect. I think starting as in a startup has other advantages and disadvantages, but for me, I brought some skills in terms of managing a P&L. I honed my PowerPoint skills, which are essential as you prepare these thousands of presentations. But it does weigh you down with some baggage, and I think I may have brought extra risk to my equation, because Steve, as you say, was a serial entrepreneur with a range of maturity in his startups. In hindsight, I think there was a high failure rate for a guy like me coming in from GE. I had, an army of people. I had a personal assistant. I mean, it was not easy to turn all that off. There is no travel department. There is no HR department when you've got a troubled employee. There is nothing. And so I think the ability to present ideas, to analyze a market, that I honed in the corporate world, I hope. The ability to speak and communicate in a convincing, authentic way was honed in a corporate environment, and those things continue. I mean, I do a lot of public speaking, as does Steve, on our earnings calls and investor calls, and you have to have, I think, credibility. You have to know your audience, and I think those are some of the things I learned. But I would say it was probably more of a risk baggage coming from corporate world than a clear advantage. Mm-hmm. Let's hear from Steve. That interests me, to what he learned.
I think there are two attributes. We talk a lot about the success you have traveling from one experience to the other in your past. For me, there were two attributes about my past that I think were most salient to my success. And the first one is my failures. I can talk a lot more about all the failures I had, because I learned a lot more from them than the highlights of my career I consider to be successful. The other attribute for me was the ability to attract real top-notch talent. And for me, the success that we were able to achieve was 100% due to pulling together the right people with the right motivation and the right timing and a bit of luck. And so that, combined with learning lessons from the past, you take risks, and someone's got to stand at the front of the room and set the table. But largely our success is driven by a lot of people. We just get to stand up and talk about it.
Good. So there were a few questions relating to what sort of promises to make. This is a sort of classic conundrum in entrepreneurship: how aspirational to be, and is that different as you go pitching into IPO bankers or investors? And so this is a dangerous question. I appreciate you may want to answer somewhat obliquely, but do you have any thoughts on that? To start with Francois.
Okay, starting with me again. Yeah, I think it is a challenge to maintain the right balance of optimism that got you here, keeps you here in this challenging environment with realistic, achievable milestones. As you speak to your bankers, about what you think you can achieve, as you speak to investors before the IPO as well as beyond, and setting those expectations. I continue to learn in that process because I'm fairly optimistic, and I always try to be truthful about what we believe we can achieve. But sometimes, as Steve says, things take longer, and I don't like to build in, a fudge factor every time I target something. But here we are in COVID, right? We got our CE mark last year. We got it. We announced it in March. Lucky us, as the sky fell. Nobody noticed, and everything was delayed. But investors are tired of hearing, "Oh, it's COVID." It's true to some degree, but okay, what can you work on? What can you move forward? So you have to be honest. You have to communicate. But I remain an optimist, and sometimes I have to say, "Hey, we thought we'd get this done a little faster, and it's still going to happen, but it'll happen a little later than usual." Steve, any lessons for me here as I remain on the front lines that you've gleaned?
Well, it's an interesting challenge because, as you transition to public issuer, you are constrained by lots of rules and regulations. And so transparency and disclosure are always paramount. And you have to be careful because the markets can be brutal if they interpret your plans as being, achievable, and you're skating the edge. I think, as I said in one of my last slides, the markets reward consistency, and it's better to have quarter on quarter the ability to meet your milestones than to have these big home runs where you can't predict the behavior of the FDA, or you can't predict the onset of a pandemic, or your ability to pivot to building ventilators if you need to. There are a lot of unknowns, and so I think you have to be careful. I think in terms of promising, there's always wordsmithing, Scott, and your lawyer is going to look at it, or your regulatory department's going to look at it, and it's always that fine balance of trying to be ambitious but realistic and also compliant, and that's a constant tap dance that you have to navigate. You become better at it once you're on the other side of being public, because there's a lot of people who are going to help make sure you do that. In our first year, I think the Venture Exchange reviewed every press release we did before we released it. So you have a lot of help, whether you like it or not, to stay on the straight and narrow.
Amazing. So they were interesting. A couple of questions about when do you know it's not working out? I guess maybe the classic entrepreneur type question from both Christine McJanet and Alessandro Biglioli this time. So either of you have any wisdom to share with us on when to pull the plug on your venture?
Come on, let's start with Steve this time. I always go first. I want to learn from him.
It's a deeply challenging question because there are usually so many stakeholders that are at stake, and at the same time, it's your life, it's your own commitment to try to get this, try to get it done. I was fortunate that we had enough support that even on the days where I thought we weren't going to make it, there was always someone there to say, we got this. But I think you have to be realistic, and at some point in time, you have to look at it from a sober, perspective, whether it's legal or whatever. I mean, companies have responsibilities to make sure they do the right thing. I think at the end of the day, you always have to put the company and ultimately its stakeholders and shareholders first. And when you can no longer do that, you sometimes have to figure out a different strategy. In my case, it wasn't about the company taking a break. It was about me taking a break. And after 5 years, of taking the company through that chapter of its growth,
Mhm.
I actually brought in Arun Menawat to take over the CEO role, to take the company on to $1 billion valuation, something he had achieved with his previous company. And, you know, you do what you're supposed to do. And I think, you know, if you're being honest with yourself, you know what your limits are and you have to stay in check. I've been fortunate that most of my endeavors have had a degree of success. And when it was time to change, I didn't resist it. I tried to flow with it.
Mhm.
I think it's a great question. And I don't think there is an easy answer. You know, I mentioned in my presentation that I think I probably went beyond what was rational at times because of my ego as well as my commitment to the opportunity, but that's very dangerous. And I know, you know, a lot of very capable, smart people with great technology who haven't made it. On the other hand, once you get into the role, I agree with Steve, it's a bit back to business. And so making those tough decisions, you know, we are developing a new technology. This is not an iteration on something that already exists. It's really new. And you can't turn to a reference paper or ask the engineer who originated this. It's you. And sometimes you run into these, you know, black boxes where you're like, what do we do? And you, frankly, the optimism that got you into it, I think, give you the confidence and calm to say, look, let's try this. Let's be systematic about it. Let's sleep on it and hit this again tomorrow. But in some cases, in my case, I came into ENDRA with a legacy business focused on selling high-end research equipment to academic research centers. And we had some very well-known customers using our product. Stanford University, Purdue, University of Michigan. We had several sites in Asia. And I realized once we were over the hump with the IPO that we didn't have enough money to kind of keep that business up and running and succeed in the marketplace relative to competition and develop the clinical version of this technology, which is what we've pursued. So at that point, I think your corporate hat turns on and you say, okay, what's the potential market opportunity? You know, what's the selling cycle? What's our competitive position? And in our case, we decided we've got to, you know, tell investors we're pivoting, we're cutting off that small revenue stream for the following reasons: long grant-driven selling cycle, not the leader in the field, and you take on the burden of, you know, executing an end-of-life strategy with a bunch of important customers who might, by the way, become your clinical customers in a year or two. So you handle that. And so I think that kind of business portfolio decision is, from what I hear from Steve, and certainly in my experience from a corporate perspective, is perhaps easier. It's that entrepreneurial, when you keep going, that I wish I had an answer. I don't think I have that answer, but at least I hope that gives you a bit of insight.
Scott, it reminds me of a story. I'll tell it very briefly because it's relevant, but it reminds me of a day when my VP of engineering came in and said, it doesn't work. And I said, what do you mean it doesn't work? He said, it doesn't work. It stopped working. We had gone from a Siemens 3.0, a 3 Tesla machine to a Philips 1.5 or something like that. I forget the exact scenario. And it was on our roadmap and we made a lot of assumptions and the assumptions turned out to be wrong. And he said, it doesn't work. And they, you know, I sensed everybody in the company was really struggling with their morale about the utter disaster we found ourselves in. And so I had movie night and I showed the movie Apollo 13. And at the end of the movie, I took some of the props from the movie and I threw them down and I said, let's bring them home. And I think everyone got it. You know, it was one of those days where everyone just took a deep breath, retrenched, and then, you know, we got back to work.
And did you make it work with the lower magnetic field?
We did make it work.
Well, there you go. That was inspired. Fantastic. So there's a couple other questions. One for Francois from John Saloninka. He asked if you had chosen the RTO route. I believe you had that as there was a shell you were looking at. In retrospect, would that have been a good idea?
Yeah, we decided against that because we felt it was going to be so hard to reconcile this shell. And for those of you in the audience who may not quite understand, company who's in some form of operation or not, but has a public listing that's still active, and they may have something on the balance sheet or in the bank account, which kind of is your side door to being public. And the legacy investors for that business, the actual operations, as limited as they were on the ground, the company name and all sort of people who knew it was this other mountain we had to overcome. In our case, I don't recall, but I do believe it was a mining company in Canada. And it was just going to be so hard to reconcile that and rebrand it that we decided it wasn't the right path. But I don't think it's a wrong path. This was, once again, not the right fit for us and the people who were still involved in that company. You get to know them and you understand what their vision is and how much they want to be involved in your company or not. And so it wasn't what we ended up doing, but I loved hearing how Steve did something successfully and complex in Toronto, because obviously it's an appropriate vehicle. It just didn't work out for us.
Mm-hmm. There's a next question is about prioritizing investors. You both have pitched hundreds and hundreds of times, and probably in retrospect realized that at least half of those were probably not worth the time for either one of you. And maybe you've learned a couple things about how to match investors to the opportunities, and if you have some wisdom on that, maybe we'll let Steve talk next.
Yeah, I mean, it takes a lot of patience, and you certainly grow a thick skin. You have to be able to understand that the risk profile or the investor profile may not be a good match. And when you're working with a bank, a lot of that work can be done up front, or at least you think it's being done up front, to screen people to better match, and at the very least, give you background information on who you're meeting. And if you have a good banker, you'll have enough due diligence to understand what the potential opportunities are and who you're talking to. Even with that, you're going to get told no a lot, even by investors you think are the perfect match. I remember being with one of our directors on a trip out to California to pitch to someone whom we thought was perfect for our deal. And I learned a lot in that meeting. We had walked in thinking we were going to do a PowerPoint, and we walked into a tower where there was no walls. The entire office was all windows. There was no screen. Fortunately, I brought paper, so we had actually, had a backup plan. And into slide 3, the investor took control of the meeting and wanted to talk about, some minutia in our budget, and I lost control. And I think it was a good lesson for me to make sure you stick to your script. It's your story. Don't let your banker tell it. Don't let your board tell it. Don't let anyone else tell it. And when you find the right investors, you'll know. You'll get to have a good feeling of who you want as your investors. You don't necessarily want anyone with money in their pocket, and that can be challenging when there are desperate times. But I think if you have a good banker working with you, you can be well prepared to talk to just about any type of investor, even if they're not going to participate.
And Steve, I would echo a lot of that. In my case, the only other points I would add are, I've always tried to keep my investor meetings fairly short, so that there isn't this, okay, let's settle in, and halfway through the date, we both realize we never want to go out again. So if it's 30 minutes intro, you can do a lot of those. It's more of a volume game. It's still obviously with some focus, but you're not wasting a lot of time. And so as I come into, and I've just come out of a couple of investor conferences, and you find out that that person's really trying to sell you structured debt, which is not something we want, you can kind of agree to, respect each other's lack of interest per se, but you're not wasting a lot of time. I'd also say, secondly, that, a lot of these conversations that I had at the beginning, that 30-minute or so conversation, was a no. And as I said, with our banker and with several investors, 3, 6 months, 12 months later, they turned into a yes. They start watching you. They like your story. They're not going to invest now, but they're watching that execution you talked about, Steve. I see them. He said he was going to do this. Now you come back a year later. That to me is a very valuable investment. Planting the seeds with people, being good about follow-up. A no doesn't mean no forever. And coming back to them without much ego and saying, hey, just wanted to keep you informed of our progress. That has paid dividends. Third point for me that made a difference is having your own money in the deal. And I don't mean, I put $5 million in. I mean, it was substantial amount for me. It wasn't $20, but it was a substantial amount. And, that's public, or you can disclose it. And people take that seriously. You're asking them to write a check. They may be a portfolio manager, or it may be their own money. But knowing you've got the deal, you've got your own money in the deal, and that skin in the game is, I think, very material. And I would say, give as much as you can. Hopefully, you're going to get it back because you really do believe in the company. But that makes a big difference. And being able to say that in a meeting has helped me several times.
Great. Well, thank you so much. So I think we're going to maybe wrap up with one more question. And your question is, suppose you find yourselves, I'll start with Steve here. You find yourselves in your next venture, whatever it is, it's in the medical device space. How will you decide whether it's the right venture and the right time to be public? Maybe we'll let Steve go.
Well, I think, again, it's not a unilateral decision. I've never been the founder. I've been the guy that's been privileged to take a company through a chapter of its growth. And I respect all of the stakeholders and what their goals are. Normally, when you get to a certain level of growth with either VC investors or private investors, you have to figure out what your strategy is for either an exit or growth, and how you're going to fund it. And it really is, a fairly in-depth discussion to develop a view of all the pros and cons of the alternatives, and there are several. I think again, don't just think about it in terms of raising money. Think about it in terms of how it fits in with your strategic goals, because it may impact your strategy about related to partnerships. Once you become public, you may or may not become more difficult to be a partner with a certain other party, or you may be more attractive if you're public, depending on what the strategic value is. So I think you have to think of it in terms of your strategy, not just your ability to raise capital. And if you can focus on that sort of broader scope, I think it's easier to have confidence you'll make the right decision.
Great answer. Thank you, Francois. What's your take?
I don't have much more wisdom than what just Steve said, except that I think for me, the decision would be largely based on the maturity cycle of the company. That, as I said, I think we went IPO'd a little earlier than usual as a development stage company. And as I said, that distracts a lot of your attention and resources, which are so critical to bringing this product to commercial stage. So for me, until we were closer, I would probably bias my interest towards private sources, good partners in the private sector. But I also want to say I really like being public. I mean, it's something that I find that pace, the democracy of being public. It's the investors and the stock market are the most efficient voting machine in the world. Sometimes you can kind of anticipate which way they're going to go. Sometimes you can't. But I love the liquidity, the transparency. I love the rigor of being public. There's risk involved. You're signing your name to something that's very serious. But I also know we run a very tight ship, and that is satisfying for me. And I'm not saying that on the private side it's not done as well, but let's say there's less oversight. So that rigor for me, that liquidity, that pace is very exciting, but I would have probably done it 2 years later, but I'd still be here, I hope.
Amazing. Well, gentlemen, it has been an utter pleasure to have you on the show here today. And I hope our audience, I know we've retained a lot of audience, and there'll be hundreds of other people who watch your presentation over time. And I know it'll have a lot of impact on them.